bank or RBC might say, okay, we'll take a little bit of loss on the mortgage, but we're going to get you back when we charge you these fees for this bank account. We're going to earn money from these investments and not make you much money. Unfortunately, the average Canadian consumer doesn't really think about it that way, and they invest with these banks. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. Well, ladies and gentlemen, we are officially on the eve of the first Bank of Canada rate cut in 2025. And if you're watching this on Wednesday, then it might have already happened. Or if you listen to this on Wednesday, it might have happened. But you still want to pay attention to this particular episode because we are going to dig into why the variable rate discounts are disappearing. Why are they going away? What's going on in the marketplace and what's even happening? Also, what's the future of rates with these rate discounts occurring, and what are people going to do? And last but not least, thinking about these tariffs is getting a lot of people on edge right now. How are you making a decision about the marketplace, knowing that we've got the reality of essentially a trade war coming at us in the upcoming weeks ahead? Now, I recently completed a full and entire episode about these tariffs and went deep into that. So if you want to find out more, check out the previous episode where I talked specifically about Trump and his tariffs. We'll just touch on that a little bit here today. But the question that everybody's asking is, what do I do in this marketplace right now, considering the potential of these tariffs? And how do I react to this current situation where variable rate mortgages are kind of going away? Or are they? Let's dig into it. But before I do, quick little heads up. If you've been listening to this episode and you listen to the podcast for a long time, my only ask from you is two simple things. Number one, hit the like button. And if you're on YouTube or if you're on iTunes or Spotify, go ahead and leave us a great review if you're liking the episodes. Last but not least, if you like this information and you want to work with us a little bit more, then go to our website, getflowmortgage.ca, or find me on Instagram at themortgagepug or at flowmortgageco. Let's get to the goods. All right, so variable rates. Let's talk about it. It's been a hot topic. So hot indeed that a recent survey of a Canadian lender indicated that over 68% of their applications in Q4, so basically really in November and December, were of variable rate mortgages. That's basically 2/3 of people taking variable rate mortgages based on the assumption that rates were going to decline pretty significantly. And most of these people taking variable rates did this before December and the rate drop that occurred in December of 2024, based on the assumption that we would continue to see rates come down into 2025. And a lot of those people could have taken fixed rates at that time, specifically in October and November, in likely the low 4% before they started to spring back up a little bit into the mid 4s and high 4s, and in some cases the 5% range. That basically says that people are betting on variable rates. And that could have been a good thing to do at that time, specifically when you think about the fact that the discounts that were being offered were discounts that haven't been available since 2022. Or before I get into what's going on with the discounts, I want to explain exactly what that is, because I think there's still people that get confused when they think variable rate. They just think of an overall interest rate like 4.5% or 4.7%. Now, it's important to note that a discount, just like a surplus, is the percentage off of prime that you pay when you get your mortgage. So if you have a variable rate mortgage today, you're not getting a rate of 4.9. If prime is 5.45, you get a discount of 55 basis points. That's 0.55% off of prime. So 5.45 minus 0.55 is 4.9. And if rates go down, your corresponding rates go down. And that's exactly how that works. And you'd be shocked how many people I talk to on a daily basis who just don't know that. And so just want to set the stage with that. So why right now are variable rates even attractive for the average person? Well, prime currently sits at 5.45%. And with the market suggesting that we're going to see the Bank of Canada cut rates 0.25% in January, and the forecast suggesting another 0.25% later this year, I guess it really comes down to who you talk to. I mean, if you have an insured mortgage and you got an insured mortgage at a prime -1 or prime -1.15, it's possible you could be sitting around 4.25 to 4.5% today. And if you're betting the odds, essentially you're saying that your overall rate on your insured mortgage, which is less than 20% down, is ending off somewhere in the ballpark of 3.9, 3.7, somewhere in that ballpark with rates coming down. But with fixed interest rates on the insured side still in the low fours, and even a couple credit unions in 3.99 range, not very many, but there's a couple out there that are doing that, the question has to be big to be asked. Like, is the risk worth the reward on a variable rate mortgage? Well, the risk itself is probably relatively limited, but that depends on who you ask, which again, I'm going to cover that a little bit later in this episode. Before I go any further into the variable rate stuff, I'm going to switch over here because I want to talk briefly about something that everyone has been asking me about lately. Not everyone, but a lot of people, which is what is going on with the 90% refinance program. Now, as a reminder, in 2024, the government announced a 90% refinance program through CMHC, essentially to open up and create more doors for Canadians in existing homes. The idea is that you allow people to borrow back more than 80% of the market value of their home, kind of like a construction loan, where they'll borrow 90% of the total cost of the renovation cost plus the existing home value. So if the reno is going to be 100, the current home value is $1 million, they'll borrow up to 90% of $1.1 million instead of 90% of $1 million, and they'll insure that. So that program is launching in January 2025, and we're just starting to see CMHC start to circulate some flyers. So I'm going to have an upcoming episode to break down all of that and exactly how it works and what you can expect and where it makes sense and where it doesn't make sense. But as a quick reminder, that program itself is coming out and will be coming out in the next couple of weeks. So you're going to see some banks announce that, and they have not been announcing it very heavily up till this point right now. All right, let's get to the main event here. So what is going on? Let's get back to this variable rates. Why are people going with them? Why are they not? And what's happening in the rate market overall? So the first thing, why are variable rates shrinking right now? And what do I mean by that? Well, to start off, as I mentioned, variable rate discounts have been lately incredible. Like I've seen prime minus 1, prime minus 1.1, prime minus 1.2 for an insured mortgage. And up until about middle of December of 2024, we were even seeing an uninsured mortgage on a 30-year side with variable rate discounts around prime minus 75 to prime minus 90 on a regular basis. And I'm not talking about renewals here because renewals are typically a little bit lower simply due to the fact there's no cost associated with arranging that mortgage. So it's already in place. It's less expensive for the lender when they're doing a renewal to essentially set up the loan itself so they can afford to take a little bit of a bite when it relates to renewal rates. So again, new mortgage rates is what we're talking about here for, say, a new purchase or a new refinance. In about the beginning of January, or I guess towards the end of December, depending on the timelines that you're looking at right now, we started to see those slowly shrink back on the uninsured mortgage side. So instead of seeing prime minus 75, prime minus 70, we started to see prime minus 55, prime minus 50, prime minus 40, depending on which bank you're looking at. The spreads on the uninsured, so that's the 20% down, over $1 million, 30 years or refinance mortgages, we're starting to see those shrink pretty significantly. And we've seen this path start to happen for quite a while. But lately, the big change that's occurring is we've been seeing those variable rate discounts narrow down on the insured and the insurable side. So with people starting to ask the question, should I go variable and taking high ratio loans with less than 20% down, the conversations around variable rates are, well, what's going on and why are they starting to change? Well, thanks to our good friend, Rob McLister, who put together a really, really, really good summary. We broke into it and got into a lot of detail as far as what this means for you and why, if you're thinking about a variable rate mortgage, you should be jumping on that train right now and not waiting for it for a long time. All right, so let's dig into specifically what's happening when it relates to variable rate mortgages and why we're seeing the shrinking discounts in the marketplace. It seems like literally, like I said before, it's only been a few weeks and all of a sudden these rate discounts have been tightening and tightening and tightening and tightening. So what's happening? How is it impacting the marketplace? And as a borrower, what exactly do you do? So last week alone, we saw the average discount below prime for floating, so rates that go up and down, where payments go up and down, shrink by about 0.5% on average. That's within just 1 week. And we're starting to see those go more and more and more away. Prime discounts that were around prime minus 1% are now starting to show up as prime minus 0.9, prime minus 0.85, prime minus 0.95, all across the board. And believe it or not, this is pretty significant. Obviously, this means higher rates for a consumer, but it also makes it more and more challenging to suggest a variable rate mortgage as the disappearing act continues to occur. So the smaller discount continues to mean higher payments for variable rate mortgages in that situation. For example, on a $400,000 loan, losing 0.5% is roughly $70 on a monthly payment. So let's break it down into two camps. You've got the uninsured mortgage, which is essentially one where you're putting down 20% or more, a 30-year amortization, purchase over $1 million, versus the insured, where you get the best rates available. You're paying for CMHC insurance. You're putting down 5% to 19.99%, and you're obviously absorbing the insurance cost, but in exchange for that, you get some rock bottom interest rate. So in the uninsured side, you see right now, the lenders are blaming it on what they call tightening spreads. Basically, the lenders are seeing smaller margins between prime, the bank's prime, and the short-term funding costs, a place where they get essentially their money. In short, the banks themselves, one of the reasons that they are tightening the spread on these uninsured mortgages is because, first and foremost, they're looking for higher returns on that cash, specifically in these floating rate situations. And there's a lot of reasons behind this. And to be transparent with you, I don't really fully understand all the reasons behind it. I'm sure someone out there does, and perhaps they can reach out and have a conversation. But I'll share with you what we do understand and what we do know, which is that one of the reasons it's happening is because, and they've indicated this, we've seen rising funding costs, basically a higher cost associated with funding an actual mortgage itself. And the profitability goals from the banks are tighter, meaning they want to make a specific amount of money off of these loans. And so with the cost rising, whether it be the setup fees, paying commissions to staff, paying commissions to sales agents in the bank, paying commissions to brokers, whatever the heck it is, they're essentially saying, we're going to give you less in the way of discounts. We're going to hold pretty tight on our margins because we want to make our money. That's the short version. When it comes to insured mortgages, it's a little bit of a different game because remember, insured mortgages, well, they're in a different category and there's different types of lenders out there. While the banks and the credit unions pretty much run the world as it relates to uninsured mortgages, in the less than 20% down crowd is very different. You've got lots of monoline lenders out there. And essentially, a lot of these lenders work within something called MBS, which is mortgage-backed securities. The short version is that there's investors out there dictating the costs associated with certain funds. And with these funds, you'll note that they have a variety of expenses associated with providing a mortgage. Again, commissions, servicing fees, guarantee fees. And the investors themselves are just struggling to justify buying these MBS mortgage-backed securities after factoring in all of these fees, which basically means the cost of obtaining the loan is higher. And so for that reason, they're going to offer a lower spread because they want to continue to make sure they're keeping their profits. In addition to that, there's limitations around what CMHC will support, with CMHC being the preferred option of most investors. CMHC will only offer $2 billion in semi-annual floating rate funding, which is simply not enough for the demand that's out there. Really, in order for lenders to continue to be able to offer these incredible terms, they need to find more consistent funding to be able to offer these types of discounts. Now, the mortgage finance companies that are out there, such as the First Nationals, the MCAPs, the RMGs of the world, all these different lenders, they're good for Canadian consumers. They're good. We want them out there because they continue to keep competition. But the way that our banking world is set up in Canada, it's not advantageous for the consumer. Remember that. It's advantageous for the bank, which is crazy, but it's true. It's just the way it is. And these MFCs or mortgage finance companies or monoline lenders, depending on what you call them, they face some serious disadvantages as it relates to the marketplace. The first one is, number one, they want to keep their consumers at renewal, but they do not have the ability to cross-promote. Remember, a lot of these mortgage finance companies, no different than a broker, they're not selling you on credit cards, not selling you on TFSAs, GICs, line of credit products, or loans, or anything of that nature. So it's not like they could take a loss on the mortgage and benefit by getting the money over here. Whereas, bank or RBC might say, okay, we'll take a little bit of loss on the mortgage, but we're going to get you back when we charge you these fees for this bank account, or we're going to earn money from these investments and not make you much money. And unfortunately, that the average Canadian consumer doesn't really think about it that way, and they invest with these banks and they take out money in these banks and they spend more money in credit cards and checking accounts and all these extra fees in exchange for this little discount. But that puts the mortgage finance companies at a disadvantage. They don't have that option. In addition to that, these mortgage finance companies are monoline lenders, as we'll coin them. They also have the disadvantage of having higher funding costs because they rely on these investors and on these aggregators. They're not relying on you depositing money in the bank. So the banks themselves can subsidize the discounts through the revenue from other products where the MFCs don't have that option. And so it limits these other companies. And just so you know, when you're seeing these crazy high ratio, less than 20% down discounts on variable rates, it's usually not from the banks. It's usually from these other companies. And again, another reason we're seeing the disappearing act. So what you're going to see is this. You're going to find that the broker network or the network outside of the banks, because it's the variable rate offerings are usually much better, you're going to have a little bit harder to offer those discounts because they're not going to be as good as they were. And you might start to see more and more brokers shift towards recommending 3-year fixed mortgages, at least today, depending on the client profile. I sure hope they're doing the due diligence and they're running an amortization simulation and figuring out the client's goals, and hybrid mortgages because of the way the variable rate product is set up, right? There's a lot to think about there. This kind of leads in, and this is going on a little bit of a tangent, but this kind of leads into the bigger picture, right? Rate competition, the systemic issues that we're facing with CMHC, and what a borrower should connect with. And by the way, stay at the end of this episode because I will get into what borrowers should do right now or how to think about it. So the big picture stuff here is the banks themselves are prioritizing direct to consumer right now to retain clients at renewal. But I can tell you anecdotally right now, because this week we're on Thursday and we've already had over 30 calls from clients just renewing. That doesn't include pre-approvals. That doesn't include purchases. This doesn't include anything. Just renewals. And no, we haven't had a chance to do complete full calls with all of these people. But today I had 4 contact points with people at renewal. And it's interesting. The feedback that I'm receiving is so broad all over the place. And what I think is happening right now, despite what the market says about rate changes or the banks offering really competitive rates, I think what's happening right now is the banks are actually losing control. They don't have quality control and they don't have the staff to be able to keep up with it. And there's no consistency. I saw a TD renewal today with a 5.14 and I saw one with a 4.74. And that's the same product, very similar terms, not a substantial difference there. And with the client even reaching out and asking the question if this is the best offer they could provide, with the high one saying, yeah, that's absolutely it. That's all we could do. The lower one, the reason that those folks didn't end up staying with the bank was because they were just so fed up with the terrible experience that we're getting, and they're willing to pay more and go somewhere else, which is crazy, but that's just how it is right now. So really, we're saying that there's fewer offers as it relates to rates in the marketplace right now on the broker channel for somebody. But the reality is there's still a massive place in the marketplace because there's so many other significant problems. And I think the banks are just shooting themselves in the foot, to be honest with you. So this kind of leads back to the question about competition. If you're a consumer or someone in the marketplace and you're like, what do I even do here? How do I even approach this? I mean, obviously, volume still matters. A broker who does a lot of business will always be able to obtain better terms than a broker who does less business. And you'll see those massive broker networks out there, mortgage networks out there. I know we're going a little bit technical, who offer, better terms from an aggregation perspective, doing a lot of business basically. But the problem with even those networks is there still are limitations to what they're willing to offer to the smaller level brokers. There's still prioritization. And even if that happens, there's still issues in the competition marketplace, which I'm going on a rant here, but essentially these mortgage finance companies are getting shot in the foot by CMHC and the policymakers. And if there was one thing I wish more consumers knew, is that the reality is the reason that we don't have better terms in Canada than we do, and the reason that the banks get so much business, is because we keep voting for policies that have no positive impact on competition. We just keep getting essentially whatever the banks want to offer us, and that's the best of the best. And it's frustrating. And yes, we work with the banks on our side, and yes, we have great lending partners, but from a competition perspective, from a borrower standpoint, it would be great to be able to offer better options. And I don't anticipate that right now variable rate competition is going to improve unless there's a massive intervention or major shift in the behind the scenes mechanics of how that happens. Whoa, that was a lot. Okay. So the question is, what are you going to do now? So what you need to do is you need to compare your options, the variable rate options, the fixed rate options, and the hybrid options. And you also need to remember where the rate market's going, because people still think that fixed rates are going down. Well, the forward markets are suggesting that's not the case, and we're going to see fixed rates go up. And if that happens, well, if you just assume that we're going to see a rate market that declines, well, you could be in a tough spot going forward. The second thing, don't just chase the lowest rate. Consider the flexibility and the cost. Because again, if Trump's tariffs come in, we could be in a situation where, well, we're sitting here laughing and well, not laughing. You're going to be sitting there wondering what the heck I just did and why I didn't put myself in a situation where I had flexibility. The reality is most quote cheapo mortgage options are only about 0.1 to 0.2% lower than other alternatives. And if you think about like insurance, you should be taking the program or the product that makes the most sense, created based on the flexibility and the options presented. Moreover, you need to be working with someone who's knowledgeable about this. I'm doing this at 7:30 at night when I started working at 8 a.m. today, because I believe that people need to be educated about their lending options that are out there. And my team was working, honestly, I saw emails going out into the last few minutes here. I can't say that for most people, and I can't say that most people will spend the time and the energy to research this information. Someone should be able to offer you and explain terms and why discounts are going away, but they should also explain different types of alternative options that might suit your needs better than, whatever your bank was offering. I think someone right now needs to be spending the time at least understanding the basic mechanics of this. You don't need to understand it all, but just a general idea of where the bond trends are going and where prime is at. And if that's you, then pay attention to this podcast, because I dig into that. But I also think that just genuinely right now, with everything that's going on in the marketplace, it's not a bad idea to be prepared for short-term adjustments. If you're on a variable rate, consider how these things might impact your budget. Think about how this Trump situation and this tariff situation might impact your budget. And I mean, I think more people now need to create more flexibility to handle changes both in the lifestyle and the economic landscape of what's going to happen in the next couple of years. It's a very uncertain time. So I think people need to be dialed in now than ever, which is, again, for the sake of conversation, one of the reasons we use our home equity reports for our clients, that they get to see every single month where they stand for their mortgage, where the rates are at, and where their terms are at. Now, let's just quickly jump back to this tariff situation. So we know that Trump's proposed February 1st, we might see this 25% tariff on Canadian exports. The suggestion, we talked about this before, is a 6% GDP contraction. Huge. The primary industries that could be impacted include lumber, auto manufacturing, agriculture, energy. And again, although I know some of this has been broken down, but the reality is there's no consensus. BMO says, hey, we're going to see response to tariffs where we're going to cut rates early and cut them often. Scotia says, well, inflationary pressures from the tariffs might limit the rate cuts, and we might see things remain at 2%. But even they will concede that we could see rates go down 0.25% to 0.5% more. The market right now is signaling there's a high probability that we will see these tariffs occur, but it's still unknown. We could see them avoid this and maybe do a rollout. The reality of these tariffs is that even if the tariffs are reversed before the end of a 5-year mortgage term, the short-term damage to the growth and borrowing costs could linger for a long, long time, which could obviously impact a lot of those people who took 3-year fixed mortgages in the last couple of years by the end of their term. And the other thing to think about is that if we see retaliatory tariffs, which is us doing this back to them, it could be a situation where we shrink our GDP by like up to 2%, which would be absolutely insane. So if someone was really nervous about this right now, they might want to lock in rates depending on how you feel about the progression of the marketplace. Again, there's some conflict to suggest that we could see the bond yields drive lower, which would lower fixed rates, but I guess it depends on where you stay. The variable rate person should be hopping in and jumping into the marketplace now, if that's what you want to do, before the discounts slide away completely. And for someone who's playing both sides of the fence, the idea of a hybrid mortgage sure makes a lot of sense. So I'd be curious, actually, if you're listening to this, or obviously you're listening to this, I'd be curious. Drop me a line on Instagram at themortgagepug. If you're on YouTube here, comment below. What do you think is going to happen if the tariffs come in, or even if it's extended? Do you think the delay of these tariffs will change how homeowners react to the marketplace, both from a renewal perspective and from a sale perspective. If you're someone who has a renewal or a refinance, how are you judging your next couple of steps in this current situation, this current climate? I genuinely be curious, and I would love to know. Thank you so much for watching. By the way, make sure to leave that review. I'd really appreciate it. Be very grateful. And if you know someone else that would benefit from this podcast, send it along. Adios. See y'all soon. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.